Hey everyone, in this video I'm going to look at a couple of examples for how you would go about getting the cash flow statement by using the indirect method, which is the method you'd primarily use if you're preparing accounting statements in the United States. And it turns out it's also relatively straightforward, and I'm going to show this using two main examples, both of which help to illustrate how this is done. So with that in mind, let's leap into the first of these examples. So in the first of our exercises here, basically what we have is we have a balance sheet, and we also have an income statement, and we have some notes to those income statements. And that's effectively all we need to get our cash flow statement. And we're going to effectively tease out the cash flow statement by going through the balance sheet and also the income statement. And we need to deal with two overarching categories of things. One, permanent differences, which are effectively things that are in the income statement but should not be in the cash flow statement, and then two, those temporary or timing differences, which are due to effectively your accrual type accounting, and we're going to deal with both of these in turn. So focusing first on the first thing we need to put in here, we need to start off with our net profit after tax. So that's the very first thing we do. So to start off with this, we'd hunt this down at the very end of our income statement. This is basically just going to be given to you in an income statement. You can read it off. It's super easy. There's nothing really there to do. However, that is not a cash flow. And in order for us to get to a cash flow, we need to do several things. So the next thing we need to do is we need to add back the permanent differences. The permanent differences basically reflect things that are in our income statement, but are definitely not cash flows, and therefore need to be added back, or depending on what you're needing to do, subtracted off. Often it's going to be added back. So the first one we'll start with is the most obvious of these, which is depreciation. Now to get the depreciation, we need to add back our depreciation expense. Sometimes, however, this is not super obvious. So if, for example, the income statement does not report a depreciation expense, we might need to calculate it ourselves. So say you need to calculate it yourself, you'll need to get the T accounts for the relevant aspects of depreciation. So let's go and see how we might do this. So we can start off with buildings. Now what you'll notice here is in our balance sheet, there's two types of depreciation. There's buildings and there's equipment. So we need to get the T accounts for both of these. So to do your T account, you start off with your opening balance of accumulated depreciation. So here we had an opening balance of 81 to begin with. So that's our opening balance. You also have your closing balance, which you can just read off from our income statement, from our balance sheet rather here. So it's 81 starting, 75 closing. Then we need to work out what is our depreciation expense going to be. Well, in order to get at this, we first need to see have we sold any of our buildings which would have removed any of the depreciation. So here it turns out that in the notes, you can see there was a building sold which had 43,000 of accumulated depreciation. So we put this over onto our debit side, and then ultimately our depreciation expense must be 37 as a result, i.e. 37 to ensure that we have our debits and our credits balanced up. So therefore we have 37 as the depreciation expense for our buildings. We can then do a similar approach to look for depreciation expense for the equipment. So it starts off at 149 and ends at 214. Now here, if you look at the notes, no equipment was ultimately sold. Therefore we put into our T account, opening 149, closing 214, which therefore implies that the depreciation expense must be 65, i.e. 214 minus 149. We can then bring this into our cash flow statement. So in the cash flow statement here, the depreciation expense then in total is 102. So we add that back to our net profit after tax to add the next portion of our cash flow statement. We can then add on any loss on disposal of land. Now what you'll notice here is the disposal of land is not going to be an operating cash flow, and it certainly would not be a cash flow in general because it's going to be in the income statement as a non-cash expense or a non-cash profit. So with the loss on disposal of land, it itself is non-cash. Now what you'll notice is when you sell land, you will potentially get some cash flow. There's a couple of things to note here. Firstly, the cash flow that you get from selling the land is an investing cash flow. It is not an operating cash flow. So if you're generating the operating cash flow statement, it simply isn't relevant. The next thing to bear in mind is the loss on disposal or the gain on disposal. While it might add or decrease your profit, it is not itself a cash flow. Rather, it represents the accounting profit or the accounting loss after taking account of depreciation and the like. So in this case, we can just read off the loss on disposal and also the gain on disposal. So here the loss on disposal of land is 118. That's just part of the income statement. What we need to do is we need to add that back because that's a non-cash reduction in our profit. We can do similarly with the gain on sale. But obviously here the gain on sale is increasing our profit even though it's not a cash flow. So we need to subtract it off. And this then gives rise to our total permanent differences so far and our total change to our net profit after tax so far. However, the permanent differences aren't the end of the story. We also need to look at timing differences, which basically represent issues to do with accrual accounting and the like. So with our timing differences, we might want to start with the changes in accounts receivable. Now, why is this the case? Well, when you have an increase in your accounts receivable, what this is going to do is it's going to increase your profit because you will have made a sale and made a profitable sale from your accounts receivable, presumably enough. So you increase your accounts receivable representing the sale that you have generated. However, if you've increased your accounts receivable, you have not yet received cash for the things you have sold. Therefore, you need to subtract off any increase in your accounts receivable. So here the increase in the accounts receivable was represented right here, 128 to 145. So we had an increase in our accounts receivable of 17. So we subtract this off from our net profit after tax. Next, we need to deal with the allowance for doubtful debts. Now, the way this operates is when you've got an allowance for doubtful debts, our basic journal entries are debit bad debts expense, credit allowance for doubtful debts. What this means is that when you have an increase in your allowance for doubtful debts, you will presumably have had an increase in your doubtful debts expense, or your doubtful debts expense here, or your bad debts expense rather. Now, as a result, the increase in the bad debts expense would reduce your net profit. However, it is not a cash flow. So you need to add back your increase in the allowance for doubtful debts. So here that increase is 4, so you add back 4 to your net profit after tax. The next thing we might do is deal with the decrease in inventory. Now here the way an inventory would usually decrease is that generally arises when you've sold goods. So for example, you decrease inventory arising from COGS. And basically what happens here is you go debit COGS or debit cost of goods sold, credit inventory. So therefore what you need to do is you need to add any decrease in inventory. The reason that's the case is you're effectively adding back any reversal in cash flow. And you've decreased your inventory. You've effectively generated a cash flow from the sale. So you're adding back a decrease in your inventory here. Now the reason you're doing that is you need to take account of the joint effect of the accounts receivable and the inventory effect. Hence why you're adding back any decrease in the inventory that has occurred. Now what you need to do is you also need to do with accounts payable. So if you've increased your accounts payable, that effectively means there's been kind of a hoarding of cash, i.e. you have paid off fewer of your short-term debts. As a result, you need to add back any increase in your accounts payable. So here the accounts payable went from 51 up to 87, suggesting you need to add back 36 in this case, i.e. you're adding back your increase in your accounts payable. And again, like I said, the way to think about this is if you've increased your accounts payable, that means you'll be able to keep more cash and pay out less cash to the people that you owe money. As a result, your effective cash flow goes up. That's an intuitive way of thinking about why you're adding back the decrease in the accounts payable. Next thing you need to deal with is the accrued expenses. Now, accrued expenses represent the miscellaneous other expenses you have not yet paid off. They're expenses that are now becoming a liability because you need to pay them. However, if you have not yet paid them, that is effectively you being able to retain some cash flow here. As a result, you add back any increase in your accrued expenses. So that's what we've done here. The accrued expenses were 11, they're now 27, representing a $16 increase. So the next thing we can finally do is deal with our income tax payable. Now here the income tax payable decreased. The income tax payable went from 23 to 15. What that suggests is that the firm has paid off $8 worth of income tax. This represents a cash outflow, and in particular a operating cash outflow. As a result, you're going to need to subtract that off. So you subtract off the decrease in your income tax payable. The overall result then is your cash collected from customers overall ends up being $249 in this case. So effectively what's happened here in short is we started off with our net profit after tax. Then what we needed to do is we needed to deal with any permanent differences, which are basically representing things that changed your income tax or your income after tax, but should not belong in a cash flow statement. Then the next thing you need to deal with is the timing differences, which basically represent any increase or decrease in your cash flows that are arising due to, for example, liabilities increasing or you paying off some of your liabilities. The basic rule of thumb here is that if you've increased some of these liabilities, so for example, you increased your income tax payable or increased accrued expenses, that basically means it's kind of reflecting an increase in your cash. By contrast, if you're paying off some of these things, so for example, you're paying off your accounts payable, or you're paying off your income tax payable, or alternatively, if you've got fewer accounts receivable, that basically reflects a decrement in your cash. So that's how you're dealing with it here. And hence why after we've dealt with all three of these things, we end up with our total cash collected from customers. We can now solidify this whole process by looking at yet another example of how to get your cash flow statement by using the indirect method. So in this other one, we have a slightly truncated example to some extent. What we have here is we have a balance sheet and we have various notes to this balance sheet, and we need to use this information in order to generate the cash flow statement. And we're going to do this in much the same process as I already remarked. So let's have a look at how we might go about doing this. So in our first thing we need to do here is we need to put in our net profit for the year after tax. Now in this case, you're told this in the notes to the financial statements. You were told that the firm had a net profit of $67,000 for the year. So we can just read that off and put that at the very beginning. Now, much like before, we need to deal with permanent differences and we need to deal with timing differences. So we're going to need to put both of these into our cash flow statement here. Now, rather unsurprisingly, the first permanent difference that we might use to alter our net profit after tax to get our cash flow statement would be something along the lines of depreciation. So to do this, we need to get our depreciation expense. So we can see how we do this. What we do is we start off with our accumulated depreciation accounting items here. So we've got accumulated depreciation for buildings and for equipment. So we can construct the T accounts for both of these. So we start off with our opening balance, say $15,000 for the buildings, and we've got our closing balance, say $15,000 here again. Now you're also told some information in the notes. In the notes here, you're told that there's a sale which is going to wipe off $5,000 in the accumulated depreciation. So what this means is you start at $15,000, you end at $15,000, but you had a $5,000 decrement. This means you must have had a $5,000 depreciation expense. So if we've got this $5,000 depreciation expense, we're going to need to add this back. So what we do is we add back the depreciation for the buildings first. Now what we can next look at is the depreciation for the equipment. So before, we have our opening balance of $16K, we have a closing balance of $5K. You're also told there's a sale of $15K, or a sale that rather results in a $15K reduction in your accumulated depreciation. And you're again told this in the notes. So what can we see here? Start at $16K, end at $5K, but we had a decrease of $15K. So what has happened here? Go to 16, start at 16, it goes down 15, so it's gone down to 1. But it then is ending up back at 5. That implies you must have had depreciation expense of $4K during the year. So we then need to add back the $4K due to the equipment depreciation. So far we've got the main types of permanent differences that might arise in your cash flow statement here. Now the next thing you might want to look at is the loss or gain on sale. Now this is important because, as I've already remarked, there have been sales here, and you know that there have been sales because of the things that you're told in the notes. However, here you only have the balance sheet, you don't have the full income statement. As a result, you don't know whether there's a loss on sale or a gain on sale from this income statement. So what you need to do is you need to work this out by working through the journal entries. So let's have a look at what this might look like. So with the buildings here, what we have and what you're told here is there was a building with original cost of 20k and accumulated depreciation of 5k, which was sold for a cash price of 20k. So what you're told is there's going to be a debit cash of 20k. You're also told that there's going to be a debit accumulated depreciation of 5. You were just told this in the notes. You're told the building had the balance sheet value of 20k. You're again told that. So when you do the summation of this, that basically means to get your debits and credits to balance, you must have got a credit here of 5k from the gain on sale. So that means you must have to here remove loss from the sale of the land here, of the building rather. Now what we can then look at is the equipment. Now with the equipment, what are you told? Well, you're told here a piece of equipment with an original cost of 25k, accumulated depreciation of 15, was sold for a cash price of 5. So what you know here is there's going to be a debit cash 5. You know there's going to be a credit to your equipment of, in this case, 25. And you know here that there was accumulated depreciation of 15, so you know there'll be a debit accumulated depreciation of 15. So what this means is your total debits so far sum up to 20, your total credits sum up to 25. This therefore means you must have had a debit loss on sale of 5k here. So you then need to do with the loss on sale, and because that loss on sale would be reducing your net income, you need to now add it back, i.e. much the converse of when you have a gain on sale. So these two, in essence, effectively cancel one another out, but we need to at least note them so that we know and can keep track of the losses and the gains on sale of the pieces of equipment and buildings here. What we can now look at is some other adjustments that might arise. So let's first look at the accounts receivable. So here what's happened is the accounts receivable went from 82 to 176. What that effectively means is our customers haven't paid us yet, and those accounts receivable have gone up, increasing our net profit even though we haven't gotten any cash. So we need to subtract that off. So we're subtracting off 94. The 94 is coming from 176 minus 82 here. The next thing we can look at is inventories. So here our inventory has gone from 64 to 117. What that effectively implies is that inventory is increased, basically meaning we must have paid some cash for this inventory. As a result, we're going to reduce our cash flows here. So we're going to reduce it down by 53. The next thing is accounts payable. So the accounts payable here went from 62 all the way to 107. So what that means is our accounts payable have gone up. That means we have so far refrained from paying some cash to our suppliers. As a result, our cash has implicitly increased. So it's gone up, in this case, 45, which is the 107 minus 62, which is relatively straightforward here. We're just reading off a subtraction. In terms of accrued expenses, again, we can read this off. So our accrued expenses went from 6 to 5. That means we must have paid 1,000 worth of accrued expenses. So we'll now need to reduce our cash flows by 1,000. In terms of income tax payable, that went from 4k to 10k. That means we must add on 6 because we've now effectively refrained from paying some other income tax this year. As a result, we're going to have a 6k increase in our cash flow here. So this then gives us our overall net cash from the operating activities. Here the overall is negative 18. That tells us the firm is effectively spending more than it's bringing in terms of cash flows. That's not necessarily a bad thing. Sometimes this arises for a startup type company, but however, it can also arise for a company that is doing badly. To get more of a picture about what stage of the life cycle the firm is in, we oftentimes need to look at both the investing cash flow and the financing cash flow. Here, what we can see is we're getting a profit in, and oftentimes a lot of the adjustments here are coming from non-cash items. To add some more color to this, let's have a look at the investing and the financing cash flows. So in terms of the cash flows from investing, you're effectively told two overarching things that are relevant here. You're basically told that there was sales, and you need to deal with the cash flows associated with these sales. And those are the only activities you're told about that are going to be relevant here. So to do this, let's have a look at our T accounts to verify that there were no purchases or at least to see what the cash value of these is. Because effectively what we have here is we're told there was a sale of buildings, we're told there was a sale of equipment, but we don't know if the firm also purchased some buildings or equipment, and we need to see whether they did in order to get a complete picture about the firm's cash flows from investing. So here let's have a look at the building tier account first. It had an opening balance of 51, which we can read off the balance sheet. A closing balance of 21, again we can read that off the balance sheet. You were also told the firm sold 20k worth of buildings. You were specifically told this in the notes to the financial statements. So when you do this, your total debit side is going to sum up to your total credit side. As a result, there would be no purchase here. We can also do the same process with equipment. So the equipment here had an opening balance of 55k. Again, just reading this off the balance sheet. It had a closing balance of 30k, again reading it off the balance sheet. You're told here that there was a sale of equipment worth 25k. Again, that is in the notes to the financial statements. So as a result, we can add up the debit and the credit columns, and they both add up to 55. What this implies is that there were no purchases in this particular scenario for our firm. So we can then bring together our investing activities cash flows. And the basic way this works is we only really have two. We have the cash we got from the sale of the building, the cash we got from the sale of the equipment. Now here the building netted us 20k in cash, the equipment netted us 5k, so we've got a 25k inflow from our investing activities. So again, relatively straightforward in this case, because there aren't any other cash flows that are presently relevant. What this tells us is the firm might be nearing a maturity or decline type stage of its life cycle because A, our operating cash flows are negative, and then B, our investing cash flows are positive, telling us we're selling off more equipment or more property, plant and equipment than we're buying, suggesting the firm might be heading toward a bit more of a decline rather than the startup type phase. Because in the startup type phase, you would often actually be spending quite a bit of money on property, plant and equipment. However, let's also look at the financing cash flows to see where this is headed. So with our financing cash flows, there are a few typical areas in which you have cash flows. You have repaying debt, either short-term or long-term. You also have cash flows associated with us paying out dividends to shareholders. Again, to be absolutely clear here, when we pay dividends to shareholders, that's a cash flow from financing. When we receive dividends from our investments, that's an operating cash flow. So here the dividends specifically pertain to paying out dividends to shareholders. There might have been a share issuance or something along those lines, or conversely, the firm might have bought back shares. In either case, we'll need to look at share capital to see what's going on there. So those are the main possible cash flows. Now that's not to say it's an exhaustive list, but those are the main ones that would arise, and they're the main ones that are plausible in our particular problem scenario. So let's go through and see what the amount of those cash flows is if any, and it could be zero, but we need to verify whether or not those cash flows have in fact occurred. So starting off with the loans, we can just read this off the balance sheet. And we can get this by looking at the liabilities and equity portion of the balance sheet here. So what we can see is we can read it straight off the balance sheet. Looking at our short-term loans, you can basically just read that directly off. Going from 5k to 3k means we must have spent 2k in cash. Reading it straight off the balance sheet here. Nothing else to really say about it. In terms of long-term debt, we don't actually seem to have any other long-term debt. Now here, to be absolutely clear, when we're referring to these specific types of cash flows, this is a cash flow that is associated with paying off the principal of that financing instrument rather. So paying off the principal of the loan, or conversely from going out and getting cash from borrowing. In either case, we don't seem to have long-term debt that is going to impact things here, and we can just read that directly off our balance sheet. So we don't need to do anything in relation to that at this point. Of course, there simply isn't a balance sheet item associated with it. Now, in terms of dividends, the way that we'd look at this is we need to look at our retained profits. Now, the reason for this is when a firm pays dividends, this comes out of the retained profits. So to identify if the firm had paid dividends, we need to look at the change in the retained profits and see if that change can be explained by the net profit that the firm had generated. So let's have a look at that T account for the retained profits. So having a look at it, we can start off by firstly examining what exactly has happened. Here, starts off at 73, ends at 113, and we're also told the firm had a net profit for the year of 67,000. So what is this going to look like? Well, in terms of what it looks like, we had our opening balance of 73k, we had a closing balance of 113, as I just mentioned. Now we also noted there was a profit of 67k. So this then goes on to our credit side, 67k. So our total credits sum up to 140. Therefore, our debits also have to sum up to 140. What this means is there must have been 9k worth of dividends that the firm must have paid. So what we're going to do is we're going to get a cash outflow of 9k associated with the firm paying dividends. So we'll have a dividend related cash flow here. So that again is relatively straightforward to read off the T account. The next one is share issuance. To identify if there was a share issuance, we need to look at the share capital. So the share capital here, again, is on the balance sheet, and it starts off at 88 and ends at 98. Now what this tells you is that there would just have been a share issuance. We know this because there was no bonus issue, because the only way for share capital to otherwise increase would have been a bonus issue, and there was no bonus issue. And you can identify this looking at the notes here. So there was no bonus issue. Also, there is not a buyback. And if there's no buyback, there's no way for the share capital to have otherwise decreased. So here the firm must have issued 10k in shares. And this is just a relatively straightforward reading off of the balance sheet. So looking at our financing activities overall, what we had here is we paid off 2k in short-term loans, there was 10k from share issuance, and the firm paid 9k in dividends. So there was a cash outflow of 1k in the financing activities. Again, this would imply the firm is not really going out and getting a lot more money, because the firm appears to be spending more money than it's bringing in terms of financing. So that's effectively what our financing aspect of the cash flows is going to look at. So if we put all of this together, we can put all of the cash flow sections into our total cash flow statement. And this particular set of numbers here is just putting together our operating cash flows, our investing cash flows, and our financing cash flows. And when you break it down into bite-sized chunks, it's relatively straightforward to work out where all of these numbers are coming from and to put it together in a coherent and logical and ordered manner. So I hope this has given you an idea about how you'd go through and get the cash flow statements by using the indirect method. I hope this has been relatively informative to you, and like I said, I hope it's given you some insight into the indirect cash flow method. So thanks a lot for listening to this video, and all the very best with your accounting and finance study.